Usually when we sit down to crack open an earnings report, we kind of have to brace ourselves.
Right.
It's a lot of, dry corporate speak, a polite nod to the shareholders, maybe a little spin to make a loss look like a strategic realignment, and then everyone moves on. But every once in a while, a report drops that feels less like a spreadsheet and more like a mic drop.
Yeah.
And that is exactly what happened with Valero Energy this morning.
It really was a statement piece. We are talking about their Q4 2025 earnings released just today, January 29th, 2026.
Yeah.
And the immediate buzz isn't just that they beat expectations, it's the sheer magnitude of the beat. It feels like they're operating in a completely different reality than some of their peers.
That's the vibe I got, too. I mean, just look at the headline numbers. Wall Street, smart people with very expensive models, was expecting earnings per share of around $3.10.
Which would have been fine. A solid quarter?
Totally respectable.
Yeah.
But Valero comes in and posts an adjusted EPS of $3.82. I mean, that's not a rounding error. That's a crushing victory.
It's a massive gap.
Yeah.
And the market reacted accordingly. The stock, boom, all-time high. But for me, the most staggering stat wasn't even the EPS.
Oh, yeah.
It was the cash return. In 2025 alone, Valero returned $4 billion to shareholders.
$4 billion.
That is just a massive amount of capital flowing back to investors. It validates their whole strategy.
It's incredible. So the mission for this deep dive is pretty clear. We are just going to sit here and applaud the balance sheet or list off numbers. We need to understand how they did it.
Yes.
Because when you peel back the layers, this isn't just a simple story about oil prices. It's about extreme efficiency, some clever strategy with heavy crude, and yes, we have to talk about Venezuela.
Definitely. That is a geopolitical shift that is paying dividends for them. Big time.
And on the flip side, we have to unpack this really tough, complex decision to shut down a major refinery in California while they are, practically printing money everywhere else.
That contrast is actually the key to the whole thing. You've got record-breaking performance in the Gulf Coast and the Midwest, and then this strategic retreat on the West Coast.
Yeah.
It tells you so much about the state of energy in America right now.
So let's unpack this. I want to start with what I'm calling the machine, because to make this kind of money, your refineries have to be running at an insane level of efficiency. And the throughput numbers are just, wow.
They're historic. Valero reported record refining throughput for the year. But the number that really jumps out, the one that made me double-check the transcript, is the utilization rate in Q4.
Okay.
They were running at 98% capacity utilization.
98%. Okay, so for the listener who doesn't spend their life looking at refinery specs, put that in context. Is that good high or dangerous high?
It's Formula One high. The industry average usually hovers around, 85%, maybe 90% if things are going well.
Right.
98% basically means you are redlining the engine for 3 months straight without blowing a gasket.
Which is incredibly risky if you don't trust your equipment.
Precisely. In the refining world, downtime is the enemy. Every minute you're not processing crude is money just vaporizing. Running at 98% implies an incredible level of mechanical availability. In fact, Lane Riggs, the CEO, he explicitly said 2025 was their best year ever for that.
Which creates this huge competitive moat. Right. Because while competitors might be struggling with unplanned outages or maintenance, Valero is just churning.
It converts reliability into cash. If margins are high, which they were, and you're the only one running full tilt, you capture all that upside. But running that hot actually leads us to a bit of a mystery.
Oh, right. The inventory puzzle. I was hoping you could clear this up for me.
Yeah. So there's a lot of chatter about inventory levels, specifically inventories of light products. So gasoline built up significantly in November and December.
Especially in the Gulf Coast, right? PD3.
Exactly. And usually when inventories build up like that, the market starts to panic. The assumption is, oh no, demand is crashing.
Right.
Nobody's buying gas. That's the typical reaction. But Valero's take was very different. They aren't seeing a demand problem at all. Gary Simmons, the COO, he pointed out that while gasoline sales were flat, distillates...
That's diesel and jet fuel.
Right. Distillates were actually up 13% in their system.
13% is a huge jump. So if demand is actually fine, why is there so much extra gas sitting in storage tanks?
It goes right back to that 98% utilization number. Valero, and presumably others, were running so hard because the margins were so good. Combine that with really mild winter weather.
So they basically just overproduced.
They overproduced. They were too efficient for the market to keep up in the short term.
A problem of their own success.
In a way, yes. But here's where it gets really nuanced. There's a genuine debate brewing between Valero's internal data and the external industry consultants.
And Valero saying, not so fast.
Correct. The consultants are looking at the macro data and saying, the market is balanced, supply equals demand.
And Valero thinks they're being too optimistic.
Way too optimistic. Gary Simmons basically said the consultants are modeling that new refineries, startups in the Middle East, Africa, or even Russian refineries, will run at full nameplate capacity immediately.
Which practically never happens. It's like assuming a new factory won't have teething issues.
Exactly. Valero's internal numbers paint a much tighter picture. They see net global capacity growing by only about 400,000 barrels a day.
Okay.
But they see global demand growing by 500,000 barrels a day.
So the world wants 500,000 more barrels, but we can only make 400,000 more.
Right. And that gap, that 100,000 barrel deficit,
Right.
that means tightness. And in commodity markets, tightness means high margins for the refiners that can actually run.
So they're betting on the world being structurally short on fuel. That explains the confidence. Okay, let's pivot. We talked about how much they're selling. Let's talk about what they're buying. This brings us to the heavy advantage.
This is the real alchemy of refining.
It really is. I love this part of the business. You take the nastiest, thickest, cheapest oil and turn it into premium fuel. And Valero seems to be the king of this.
They have the most complex kit, for sure. This all relies on sour crude discounts. Valero makes more money when heavy sour oil is cheap relative to the light, sweet stuff.
Because their refineries can handle the junk that others can't.
They can. And there was a big name drop in this report that we haven't heard in a positive context for a long time: Venezuela.
Yes. Venezuelan crude is back.
It's back in the mix.
I feel like we haven't talked about Venezuelan oil in a serious commercial way for years.
Yeah.
Because of sanctions. How big of a deal is this for Valero?
Historically, it's massive. Before the sanctions, Valero was the largest buyer of Venezuelan crude. We're talking something like 240,000 barrels a day.
Wow.
It's the perfect feedstock for their Gulf Coast plants. Heavy, dirty, and cheap.
And they aren't just going back to the old playbook, are they? The report mentioned they've actually upgraded since then.
That's the kicker. Since the last time they bought Venezuelan crude in bulk, they added a new coker at their Port Arthur refinery.
And a coker is basically the machine that crushes the really heavy stuff.
Essentially, yes. It cracks those heavy, long-chain molecules into lighter, valuable ones. So now they have even more capacity to process this heavy crude than they did before.
It's like having a cast iron stomach. They can eat the cheapest ingredients that would make other refiners sick, and turn them into a gourmet meal.
That is a very apt analogy, and there's another counterintuitive point here about shipping costs that I found fascinating.
Oh, the freight rates. I saw they're up 30%. Usually when shipping costs go up, businesses complain, but Valero didn't seem too upset.
No, they weren't. In fact, they view it as a competitive advantage.
Okay, you have to walk me through that. How does paying more to ship oil help you make money? That breaks my brain a little bit.
It's all about the spread. Think about Canadian heavy crude. It flows down pipelines to the Gulf Coast, but it competes with imported heavy crude coming on ships.
Okay, so Canadian oil versus imported oil.
Right. Now, if the cost to ship that overseas crude goes up, the landed cost of that import spikes.
So the import becomes the expensive option.
Exactly. So to stay competitive, the Canadian producers have to lower their price. They have to discount their oil to make it attractive compared to the expensive import.
So the high shipping cost acts like a force field that pushes down the price of the local heavy stuff.
Perfectly put. Right now, heavy Canadian is trading at something like $11.50 under Brent. That is pure margin for Valero.
That is the kind of detail that separates the casual observer from the deep diver. It's not just oil price up, stock up. It's about the spread.
Always about the spread.
However, we have to address the elephant in the room. It's not all sunshine and rainbows. We have to talk about California. Valero is shutting down the Benicia refinery.
Idling it, to be precise, but yes, effectively shutting down refining operations by the end of April 2026. This isn't a small facility.
No.
Yeah.
And the financial hit is real. A $100 million depreciation charge. But what struck me was the reasoning. It wasn't. It wasn't about economics in the usual sense.
Indirectly, yes. Management cited mandatory inspection requirements coming up. Essentially, they looked at the bill to keep it running, looked at the regulatory environment in California, and said, it's not worth it.
That is a stark statement.
Yeah.
A company making billions, running at record efficiency elsewhere, decides it makes more sense to close a shop in California than to fix it.
It signals a profound shift. Valero is transitioning from a manufacturer in the Bay Area to an importer. They'll still supply their customers, but they'll bring the fuel in on ships.
Which means California becomes even more dependent on imports.
Correct. And it highlights that growing divide between the energy-producing states like Texas and the energy-consuming states like California. The profitability gap has just become too wide.
It's a tale of two Americas. Okay, but let's pivot to something where Valero is surprisingly ahead of the curve.
Yeah.
Renewables. Their renewable diesel segment, DGD, is printing money.
DGD, Diamond Green Diesel, is a joint venture, and it is an absolute beast. The rest of the industry struggled. In Q4, margins were thin, feedstock was expensive, but Valero's segment made $92 million.
How are they making almost $100 million when everyone else is losing their shirts? Is there a cheat code?
In a way, they do have a cheat code. It's the PTC, the production tax credit. But the real secret sauce is the feedstock.
What are they feeding the machine?
Waste. Animal fats, used cooking oil, corn oil. These are waste products, so they have a much lower carbon intensity score than simple vegetable oils like soybean oil.
And in the world of tax credits, lower carbon intensity equals a higher payout.
Exactly. The tax credit isn't a flat rate, it scales. By using waste instead of food, Valero maximizes the credit. Competitors using straight soybean oil just can't compete with those economics.
That is so smart. It's taking literal garbage and turning it into a high-margin fuel.
And looking to 2026, they think it gets even better. They're waiting on the government to set the RVO, the renewable volume obligation.
That's the mandate for how much renewable fuel has to be blended in.
Exactly. If that mandate goes up, it's just a tailwind for demand.
And we can't forget ethanol. I feel like ethanol is the unloved stepchild of energy sometimes, but Valero made $117 million there in Q4.
Record production volumes, too. The economics are simple. Corn is cheap, and the world is realizing ethanol is the cheapest way to add octane to gasoline. Exports are booming.
So there's another tax credit, right? The 45Z.
Yes, the 45Z Clean Fuel Production Credit. This is the next frontier. It works in increments. For every point you lower your carbon score, you get more money. It could mean an extra 10 or 20 cents of pure profit per gallon.
20 cents doesn't sound like much until you multiply it by 4.8 million gallons a day.
Exactly. It adds up to hundreds of millions in essentially free money.
Okay, so let's put the whole picture together. We've got the refining machine humming, cheap, heavy crude, and a renewables business outsmarting the competition. This generates a mountain of cash. They ended the year with $4.7 billion in the bank. What are they doing with it?
This is where the financial fortress comes in. They have very low debt, only 18% debt to cap. They don't need to pay down debt, so they are giving it back.
We mentioned the $4 billion returned in 2025, and they just raised the dividend by 6%. But I loved the comment from the incoming CFO, Homer Buller, about the buybacks.
It was a great moment. People keep asking, stock's at an all-time high. Why are you buying back your own stock? Shouldn't you wait for a dip?
A valid question. Buy low, sell high is rule number one.
Right. But his answer was purely data-driven. He said the return on their buybacks has been in the mid-teens for a decade. As long as the earnings are there, they see it as a good investment.
Wow.
They reduced the share count by 5% this year alone. Since 2014, they have bought back over 40% of the entire company.
That's staggering. It's like owning a pizza, and every year the pizza gets smaller, but your slice stays the same size. You just own more of the whole thing.
That's exactly how it works. Your claim on the earnings grows. It tells the market, we believe in our own stock more than any other investment out there.
So what does this all mean for us, for the listener trying to make sense of the macro landscape?
I think there are two main takeaways. First, this isn't just an energy story, it's an operational efficiency story. The market is clearly valuing reliability, that 98% uptime over growth.
It's the difference between buying a new car and tuning up your race car to win the Indy 500.
Precisely. In a high interest rate world, capital is expensive. You sweat the assets you already have. Valero is the master of sweating the asset.
And the second takeaway?
It's about that supply-demand tightness. Valero's success is built on a contrarian view that the world is short on refining capacity. If the consultants are wrong and Valero is right, these high margins aren't a fluke. They are the new normal.
It definitely makes you think about your own portfolio. Are you exposed to companies building speculative new projects or companies mastering the cash cows they already own?
That's the key question.
Before we wrap up, I want to leave the listeners with a thought that's been nagging me since we discussed Benicia. We have a company that is arguably the best in the world at what they do. And even they cannot make the math work in California.
It raises a provocative question. If Valero is pulling out of California while breaking records in Texas, are we seeing the beginning of a permanent fracture in the American energy map?
Is the divide between energy-producing states and energy-consuming states becoming unbridgeable?
And if so, what happens to the price of gas in those consuming states 5 or 10 years from now when the local refineries are all gone?
That is a scary thought for anyone on the West Coast, but a fascinating dynamic for anyone watching the markets.
Geography matters.
Well, on that note, we're going to let you digest all of that. Check your portfolio, look at where your energy exposure is coming from, and maybe keep an eye on those freight rates.
And don't forget to watch the spread.
Always watch the spread. Thanks for listening to The Deep Dive. We'll catch you on the next one.
Goodbye.